Screening is one of the oldest and most widely used approaches in sustainable investing. It involves applying predefined criteria to include, exclude, or prioritize investments based on environmental, social, governance, ethical, or sustainability considerations. Screening allows investors to align portfolios with financial objectives, regulatory requirements, fiduciary responsibilities, or personal values. Unlike broad ESG integration, which incorporates ESG factors into investment analysis, screening directly influences the investment universe by determining which securities are eligible for consideration. Various screening approaches have emerged over time, each reflecting different investment philosophies and sustainability objectives. Understanding these approaches is essential for evaluating their effectiveness, benefits, and limitations within portfolio management. Negative screening, also known as exclusionary screening, removes companies, sectors, or issuers that engage in activities considered undesirable or inconsistent with investor objectives. Common exclusions include tobacco, controversial weapons, gambling, fossil fuels, alcohol, or companies involved in significant ESG controversies. This approach is particularly popular among ethical, faith-based, and values-driven investors because it aligns portfolios with specific principles or stakeholder expectations. The primary benefit is simplicity and clear alignment with investor preferences. However, negative screening may reduce diversification, exclude companies that are improving ESG performance, and potentially limit investment opportunities. It also focuses on avoiding harm rather than encouraging positive sustainability outcomes. Positive screening seeks to identify and invest in companies demonstrating strong ESG performance, sustainability leadership, or superior management of material ESG risks and opportunities. Investors evaluate companies using ESG ratings, scorecards, sustainability indicators, or proprietary assessments and favor those with stronger performance. Positive screening helps direct capital toward organizations that demonstrate responsible business practices and long-term resilience. A related approach, best-in-class screening, selects companies with the highest ESG performance relative to industry peers rather than excluding entire sectors. The benefit is that investors can maintain diversification while rewarding ESG leaders. However, outcomes depend heavily on ESG rating methodologies and may vary significantly among providers. Norms-based screening evaluates companies against internationally recognized standards, principles, and conventions. Examples include frameworks related to human rights, labor practices, environmental protection, anti-corruption measures, and responsible business conduct. Companies that fail to comply with these standards may be excluded or subjected to further review. This approach provides an objective framework based on globally accepted expectations and encourages corporate accountability. It is widely used by institutional investors seeking consistency across global portfolios. However, determining compliance can be complex, and interpretations of international standards may differ. In addition, enforcement mechanisms are often limited, creating challenges when assessing actual corporate behavior. Another important approach is thematic and sustainability-focused screening, which identifies investments aligned with specific environmental or social themes. Investors may focus on renewable energy, clean technology, water management, healthcare access, sustainable agriculture, education, biodiversity conservation, or climate transition opportunities. This approach allows investors to target sectors expected to benefit from long-term sustainability trends while supporting positive environmental or social outcomes. Thematic screening can provide exposure to high-growth opportunities and align investments with sustainability objectives. However, thematic portfolios may become concentrated in particular sectors or industries, increasing volatility and reducing diversification compared with broader market portfolios. Each screening approach offers distinct advantages and limitations. Screening can improve portfolio alignment with investor values, support sustainability objectives, simplify investment selection, and enhance risk management by avoiding exposure to certain ESG concerns. However, screening alone does not guarantee superior financial performance or meaningful sustainability outcomes. Methodological differences, data limitations, changing ESG standards, and reduced investment universes may affect effectiveness. Furthermore, screening typically evaluates companies based on predefined criteria rather than assessing future improvement potential. Consequently, many investors combine screening with ESG integration, stewardship, engagement, and active ownership strategies. This broader approach allows investors to manage risks, identify opportunities, and encourage positive corporate behavior while maintaining diversified and financially focused investment portfolios.